Welcome to the channel. Money is a cornerstone of our modern existence, yet few understand the intricate systems that govern how it works. From the coins in our pockets to the digital currency in our bank accounts, money is ever present. But how does money really work? How did it come to be, and what forces shape its value, flow, and function in today's global economy? These questions delve deep into the heart of financial systems that are often shrouded in mystery. To comprehend money's true nature, we must start with its origins. In ancient times, humans relied on bartering, exchanging goods or services directly. While this system worked for some, it had significant limitations. What if someone had a surplus of grain but needed livestock? Or what if one person needed a service that another couldn't provide? This led to the creation of money, first in the form of precious metals and later minted coins. This early form of money made trade simpler and more efficient because it acted as a common medium of exchange. But the true evolution of money didn't stop there. Over time, as societies grew more complex, paper currency was introduced, allowing for easier, more flexible transactions. And in the modern age, we've seen money evolve further with the rise of digital payments, electronic banking, and cryptocurrencies. However, it wasn't until the development of banking systems in the 17th century that money truly began to take on its current form. Early banks started as simple money lenders, offering individuals a safe place to store their wealth and providing loans to others. This introduction of lending and borrowing gave birth to key financial concepts such as credit, interest, and the circulation of money. Essentially, banks began to operate as intermediaries in the financial system, connecting savers who wanted to earn interest with borrowers who needed capital. Over time, these institutions became more sophisticated, establishing a more formalized banking system and creating the foundations for modern financial markets. The real turning point, however, came with the advent of fractional reserve banking. Fractional reserve banking is a system in which banks are required to keep only a fraction of their customers' deposits in reserve, allowing them to lend out the remainder. This enables banks to effectively create money through loans. For example, if you deposit $1,000 into a bank, the bank might only keep $100 in reserve and lend out the remaining $900 to others. The borrowers, in turn, spend that $900 and it eventually makes its way back to the banking system. That $900 gets deposited into another bank and the process repeats. In this way, banks can expand the money supply far beyond the physical currency printed by central banks. This system has been crucial in driving economic growth by making more money available for investment, business expansion, and consumption. However, it also carries significant risks. If borrowers default on their loans or if banks lend out too much, it can lead to a financial crisis. This was seen during the 2008 global financial crash, where over-leveraging in the banking system contributed to a global recession. Today, the world's economy is a highly interconnected system in which money flows rapidly and continuously across global markets. Money is no longer just physical currency, but is instead largely digital, existing as data on computers and bank ledgers. In addition to traditional banking, stock markets, bond markets, and even newer assets like cryptocurrencies now facilitate the movement of money. Every day, trillions of dollars are traded in these markets, shifting between corporations, governments, institutions, and individuals. This constant movement of money drives economic activity on a global scale. However, for most people, understanding how their individual finances interact with these vast systems remains elusive. Behind this system of global finance lies central banking, the institutions that control national money supplies and, by extension, have a significant impact on global financial systems. Central banks, such as the Federal Reserve in the US or the European Central Bank, manage the supply of money and set interest rates to guide the economy. These rates influence how much it costs to borrow money, how much savings earn in interest, and how much inflation affects the cost of living. One of the most important tools central banks use is the manipulation of interest rates. By raising or lowering interest rates, central banks can control the amount of money circulating in the economy. When interest rates are low, borrowing becomes cheaper, encouraging businesses and consumers to spend and invest. On the other hand, higher interest rates make borrowing more expensive, slowing down spending and curbing inflation. Inflation is another powerful force within the financial system. It refers to the gradual increase in prices for goods and services over time. As inflation rises, the purchasing power of money declines, meaning you need more money to buy the same things. Inflation is often seen as a necessary part of economic growth. Central banks aim to keep inflation at a manageable level, as too much inflation can erode savings, while too little can lead to stagnation. In many cases, inflation is the result of an increase in the money supply. If central banks print more money, the value of each unit of currency decreases, leading to inflation. Though this can be beneficial in some situations, such as preventing deflation and encouraging spending, its effects can be harmful to ordinary people, particularly those living on fixed incomes or relying on savings for retirement. As the financial world continues to evolve, new forms of money have emerged, most notably cryptocurrencies like Bitcoin and Ethereum. These digital currencies operate outside of the traditional banking system and offer an alternative to centralized financial institutions. Cryptocurrencies use blockchain technology, a decentralized ledger system that records transactions across a network of computers, making them immune to government control or manipulation. This new form of money has sparked both excitement and concern as it challenges the traditional monetary system. On the one hand, cryptocurrencies promise greater financial freedom and privacy. On the other hand, they raise new risks, including volatility, lack of regulation, and potential for misuse in illicit activities. The emergence of cryptocurrencies and decentralized finance, DeFi, has forced many to reconsider the very nature of money itself. These developments may signal a shift toward a more democratized financial system, where individuals have greater control over their wealth and financial decisions. However, navigating this new frontier requires a deep understanding of how these systems work, as well as the risks involved. As cryptocurrencies continue to grow in popularity, governments around the world are scrambling to develop regulations that address the unique challenges posed by digital currencies. In today's complex financial landscape, understanding how money works is essential. The systems that govern money, banking, interest rates, inflation, and digital currencies are far more complicated than most realize. To be financially successful, one must understand not just how to save or invest, but also the larger forces that shape the global economy. Money is not just a simple medium of exchange. It is a tool of power and influence that can drive or hinder growth, wealth, and prosperity. Whether it's through central banking systems, financial markets, or emerging technologies like cryptocurrency, the flow of money influences every aspect of our lives. Therefore, financial literacy and awareness are no longer optional. They are essential for thriving in a world where money is increasingly abstract, digital, and global in its reach. Thank you for watching. If you found this deep dive into the true workings of money enlightening, make sure to subscribe to our channel for more insightful explorations into the systems that shape our world.